So I'd like to first of all thank Shep and Mullen. They're fabulous with their generosity and support of FinTech ecosystem. And we don't have one of their attorneys tonight because everyone's got colds or have some problem. So I'm just saying thank you to them. Thanks to Shep and Mullen. And I'd like to introduce Charles McKinney from Certain Lending. He's actually going to moderate this panel, being an expert as he would be. And we are expecting Andrew Tang from the Draper Dragon Fund. He's just running a little late, so he's probably just going to come when he comes. And I'll pass the mic over to you, and you can then let the speakers introduce themselves.
Please introduce yourselves.
I'm Mark West. I'm head of product at Streamloan. We're a digital mortgage platform.
If we have an hour, I'm going to make a longer intro than that. Maybe you should too. What's
I'm trying to get to the meat. So we're a digital mortgage platform. We allow buyers, sellers, business agents all to be on the platform. We help them from the lead all the way through closing and underwriting that loan. And basically, our goal is to make the journey to homeownership as rewarding as the destination.
Dan Rosen, partner at Commerce Ventures. We are a micro VC, which just means mini VC, and we invest in fintech and commerce-related companies, so super sector focused. We tend to invest in enabler technology-based companies. So most of the companies we invest in the fintech space are licensing technology to financial institutions, payment processors. We have a couple of challenger investments, but for the most part, we tend to invest in enablers.
Hi everyone, I'm Alex Davidov. I'm an investor with an early stage venture capital fund called Core Innovation Capital. Like Dan here, we primarily invest in fintech. We work, the overarching thesis is the companies that create value for everyday people and small businesses end up creating large amounts of enterprise value. So that's sort of the lens through which we look at every investment, and that means we invest in everything from consumer-facing tech to enabling tech that cuts costs out of the system or makes the entire system, financial system more efficient, more fair, all of those things. Seed and Series A, and some of our portfolio companies are, you might have heard of, are Ripple, NerdWallet, Mirador on the SaaS side, Health Sherpa on the health insurance side, and Mosaic on the solar lending side.
Michael Micheletti, Director of Corporate Communications at Unison. What we do, we are the first company to bring equity finance to residential real estate, meaning we are able to provide part of the down payment in the form of an equity investment to the homeowner. It is not debt. And we also have a secondary program that allows people to unlock the equity in their home, once again, without any monthly payments or interest charges. We're available right now in 12 states plus DC. 9 more states coming next year.
Long journey of the microphone.
Yeah.
Let me start with a very general question. Just maybe get on the line. What would you like the audience to take away from tonight? What are sort of the key points you'd like people to think about or take away when you talk about mortgage disruption?
Sure. I think the mortgage disruption is here for an industry that was very paper-based. In some cases it still is, but just a few months ago or years ago, it's here and it's happening now. And I think the focus is especially as a technology company who's going into this business, it's very much, it's not a Silicon Valley problem. It's a United States problem. It's obviously a world problem, but we're focused on the United States. But there's a lot of momentum and dynamics that are influencing it. You look at the post-Dodd-Frank legislation in the mortgage industry after that, you saw the cost of originating loans double overnight, right? It went from somewhere like $4,000 to $8,000 a loan, and you're seeing other macroeconomic changes happening. So you saw interest rates tick up. So now people are going from refi shops to buy shops. So there's a lot of dynamics there. You see all the millennials who basically kind of delayed having kids, moved to the cities. Well, now they're all trying to buy houses, they're starting families, and they're moving out of the cities, and they're starting to buy properties. So there's this perfect storm happening in the mortgage industry because you have a generation that's very tech tolerant, and they're trying to actually drive this change.
Okay, takeaway from tonight. I think it's really a kind of two different stories. One is the kind of, if we're talking about mortgage disruption, I think in the near term, there isn't really mortgage disruption. There is mortgage evolution. And that's going to be a lot about upgrading user interfaces and customer experiences and helping, kind of on the margins with underwriting, but for the most part, kind of the innovation is going to be on the very front end. And then perhaps even on the back end. So I think there's opportunity in servicing and how these loans are managed once they're originated. The problem, with what happens in the middle there is that it's super heavily, kind of governed by the U.S. government, and kind of conforming loans are super, kind of restricted in kind of how creative you can get. So in the long term, I think there is opportunity for disruption, certainly as innovators might access, kind of create connectivity between capital markets folks and borrowers in paths that go around the traditional, conforming, loan that, the conforming mortgage that, Freddie and Fannie, kind of manage. So I'd love to talk about that. I just think it's a long ways out. So most of the people in this room are probably thinking about the near-term evolutionary opportunity.
So I think there's a few things that I think of a lot when we talk about mortgage tech. So the first thing is know who you're selling to. Consumers is obviously a focus for a lot of startups, but consumers don't buy houses very often, and there's a lot of other players in that value chain who need and want different things. And because of that, there's a ton of reverse competition, all sorts of other deals that are happening. So just innovating for the consumer experience is often not the right thing to do. You have to be solving the problems of the real estate agent, the mortgage broker, the bank, et cetera. And sometimes through that, you solve the problems for the consumer or someone else, but always keeping that in mind and those dynamics in mind, I think are critical. We've seen a lot of consumer-facing mortgage startups that have, frankly, I think, struggled because of the misunderstanding of that dynamic. The second piece that I would say, and this is potentially, so I think on the consumer side, keep in mind, so right now we have a system where you're either renting or you're buying. And when you're renting, you're locked into sort of anywhere from 30 days to a year-long sort of deals, and maybe you're month to month. And when you're buying, you're locked into for a pretty long period of time. And a lot of that lock-in is because of the transaction costs inherent in buying a house. And a lot of that is driven by real estate commission. And so for the longer term, as we see things like Redfin and we see things like Open Listing and some of these other players reduce the transaction cost to buying a house, what will we see from consumers in terms of switching places to live? How quickly will those start to turn over, and what will that mean, or what does a new mortgage that basically needs to accommodate that look like? So I think that's an interesting question. I don't think we're anywhere near that yet, but I think medium to long term, I think it's important to remember that these things are intertwined, and that if you reduce the transaction costs on the real estate purchase side, that's going to have ripple effects into the mortgage side as well.
I'm going to play off that theme a little bit. I think as the technology integrates within residential real estate, we're going to see the process go from the offer pads, if you will, the purchase of the home, the ease of the purchase of the home is going to increase. And as you go to your Rocket Mortgage, you're going to see the application process become more streamlined. But I think where some of the challenges that we're going to see is actually going to occur on the backside is we're going to speed up the process initially at what cost on the backside in terms of education to the consumer that they're doing their due diligence long-term in the owning of this home. And I think there's going to be a lot of competitive advantage from those companies that do have that sort of secondary touch. Yes, we're going to accelerate the home buying and home owning process, but we're still going to give you that touch that's necessary to educate the consumer long-term so they're going to be in that home and they're going to be good homeowners.
So I'm gonna dig in. I was gonna ask kind of a general question about what's driving this, but you guys really talked about it a lot. Let's get into some of the longer term things. So let me just get some statistics. We have about 10.4 trillion in residential mortgages outstanding. Probably about 7 trillion serviced on 30-plus-year-old technology. Fannie and Freddie have been in conservatorship since 2008. They're net positive to the government on economic contribution to call it $150 billion probably by the end of 2019. So we have some structural things that are very antiquated. We have a TBA market that's been the same way for 30 plus years. Let's really kind of now dig in. Like we talked a little bit about okay, in the near term we'll see better user interfaces. We'll see banks investing in streamlining their processes. Hopefully, maybe see some improvement of underwriting. You made an interesting comment about maybe we'll start to kind of move around the traditional mortgages, which sounds a lot like subprime. I'm kind of interested in your takes on if you look out 2 years to 5 years, where do you see things going, and who do you think is going to be kind of coming in and kind of really attacking those problems? And I'll just kind of throw out whoever wants to take it.
Well, since somebody else will talk, I'll just talk. 2 to 5. We said 2 to 5 years.
Yeah, say 2 to 5 years out, or 7 years. Where do you see things go?
Okay, that's a big range. I mean, 2 years, nobody. I mean, I don't think anything meaningful changes in 2 years in terms of a fundamental difference in the way that mortgages are offered. I think the interesting opportunity in sort of lending as a whole, but I think mortgage is certainly one of them, is the opportunity to compete with banks is rare, right? Banks have access to capital at kind of tremendously low cost, and actually very good distribution. The opportunity to compete with them is really channel embedded, right? So when you can offer a technology integrated kind of origination opportunity for a sort of an ecosystem of capital markets players, that's pretty interesting. My comments about disruption over the longer term were more about the fact that kind of the the requirements involved in the conforming mortgage are the conventional conforming mortgage are some of them make sense, some of them are driven by a horrific mortgage crisis, and they slow down the process to the point where you only have to hear this pitch so many times where you're okay, so the best you can do is take this down to 15 days. 20. What's and I get why the appraisal is important, and maybe it'll always be there, but there's some systemic issues with the way that loans are originated today. And candidly, the thing I sort of throw out there is just nobody wakes up in the morning and says, I want to get a mortgage. People say, I want to go get a home. I'm going to buy a house. And so if you think you're the center of the user experience, you're wrong. So it ought to just be part of the process. Anybody? I guess you have another one.
Yeah, I think that's exactly right, which is, people are willing to go through a lot of pain to get what they want. And great user experience is important if that's going to help the mortgage broker close. But I think for many consumers, something that they're going to do maybe 2 or 3 times in their lifetime, it's not a dramatic, it's a pain in the ass, but so is lots of things. And until everything else has been totally techified, people are just not going to choose mortgage lenders just on the basis of their tech. I think they're going to still shop with who they trust, what real estate agent recommends them, what are the rates. Those are still going to be the driving principles here. By the way, similar in insurance. I think that's still the case. So I think that's an important, sort of maybe to your point, which is I don't think things are going to change that much in the next couple of years. Where I think tech's got to play a meaningful role is on the reducing the defects. I think a lot of the work that goes into producing a mortgage isn't really about the underwriting the risk. It's really about making sure you're checking all the boxes and making sure that all the reps and warrants are tied out. And that's sort of a very small percentage of the loan itself in terms of the risk that you're trying to capture, or sort of time relative to risk feels very imbalanced there. So that I think what we are going to see is we're going to start seeing more and more startups are able to start guaranteeing and pre-underwriting mortgages. So, and I think we're seeing this with a few startups already where you can walk in, especially if the markets continue to be hot, and present a cash offer effectively. Waive your loan contingency because the underwriting happens so quickly that you can basically insure against that very small percentage chance that there's something that you haven't checked. I think that will be interesting. That will shorten the process, and that will be a great user experience for consumers, and it will make them more competitive and sort of apples to apples when people bid on a house. And it's also much better for the seller because they'll have more certainty that the price is going to close. And then I think the other piece of this is the servicing that we haven't really talked about, which is, we've seen default servicing costs more than quadruple over the past 10 years. I mean, servicing costs for performing mortgages are up by about 2x. These things are up by about 5x. A lot of compliance, stuck in all sorts of forms of delinquency, terrible consumer borrower experience, bad outcomes for the banks because they're not able to flow people through the process or modify their mortgages as quickly as they really should be able to actually maximize returns for them and for their investors. I think there's a big opportunity there for someone to bring some technology to that process.
Yeah, I would actually agree with everything you said. I think to me, in the way we approach it as well, is we want to make the experience better for the consumers, of course, but really, who are the people who are motivated in the transaction? It's the real estate agent and the loan officer. So making sure that they can do their job to the best of their abilities and to help accelerate, remove the waste, remove all the things that you're just like, why are you spending your time on this? That's a huge focus of what we try to bring to the table and how we try to change that experience. I also believe, and I think you had mentioned in the beginning, is the education piece. I absolutely agree. I mean, I have people who come to me that they're like, oh, so you're in the mortgage business, or you do home things, and that's all they know, right? They're like, how do I get a home? Like, literally, this is the question, and it's about making sure that they're educated, they know what they're getting into, because this is the largest transaction that most people will make in their lifetime. And I, as a product person, feel like I have to do my best to make sure that they know what they're getting into. And what we feel is our product is helping keep the human aspect in there, because it's important to have that piece of it, because it's such an emotionally driven transaction.
So let's let Andy introduce himself, and then we'll continue the discussion.
Wait, I'm early for my 7:30 panel. Apologize to my co-panelists. I just got the wrong time, but great to be here. A partner at Draper Funds, Draper Associates, Esther Dragon. We are an early stage investor. This fund has been around for 30 years. I've been there for about 17. So we basically look for interesting technology companies to back. Anything ranging from CRISPR technology to blockchain to space travel. So sort of anything that we think kind of moves the human society forward decades at a time. So we take lots of risks and have lots of fun.
I feel like my comments are way less important after here. But I guess what I was going to say was just, if I think about what's probably one of the biggest reasons of a consumer purchase of a house doesn't happen, it's probably the kind of the financing contingency that doesn't come through, the loan doesn't come through. And if I think about that process, that sort of that appraisal piece is probably the reason why this takes a long time, because the rest of it's relatively quick. I mean, or could be. So it just got me thinking, and I think it was as Alex was talking, in our world, if you're a startup or even a public company, you go to raise money, or do a transaction, you get yourself audited, right? Why isn't there a third-party, reputable, sort of appraisal, kind of company that is, a seller can engage, get the place appraised when you're going to sell the home? It's almost absurd that this is still the issue in our industry. So if I look out 5 years, I hope that's solved.
There should be enough data around.
Or just the seller's willing to. I mean, you ought to be able to get an independent appraiser who's reputable and who you could rely on. I don't know. I mean, tell me why that's crazy.
Well, I'll just I'll speak for myself on that. I mean, I think where it will go is you'll start to see automated valuation models. And that's, that's going to be piloted starting next year, just given, appraisers, I think the average age of an appraiser is like 54.
Yeah.
And there's a huge shortage, and you've got major players like Chase and Wells pushing with Fannie and Freddie. The GSEs have been outguided someone they'll accept AVM. So yeah, I mean, to your point, it's it's a big problem. Let me, does anyone else want to comment kind of on the, the consumer piece, the AVM piece, the valuation piece, the process? Because if not, I wanted to just kind of branch out and build on the comments made before about like other parts of the financial technology, the finance space coming into play, and like when you think about real estate, payments, analytics, enablement companies, really anything that comes to mind, like where do you see intersections happening? Where do you see things converging, and that really influencing how mortgage lending evolves over the next whatever time period? Yeah, whoever wants to.
So I think the real estate transaction piece is going to be a big deal. I think Zillow has basically made it so that MLSs are near obsolete because they can go and everyone's now shopping for homes themselves, right? So we don't need a real estate agent to show us around. Every single house now has a little key box that unlocks via Bluetooth. You can just download an app, see any house you want. That technology already exists. You get a real estate agent because they basically are a cartel and all sorts of other reasons and licensing. There's no real reason that we're going to have real estate agents. I mean, although I'm sure someone in this seat was saying this 10 years ago and 20 years ago and 30 years ago. So
You mean on the buy side or the sell side?
I think on the buy side for sure you will have less of a presence. You'll have that more and more automated. I think the sell side is harder. But I think increasingly you'll see sort of like some of these players who are more flat fee or focused on sort of having different players sort of run different parts of the process for you. So you'll have like a dedicated negotiator, a dedicated photographer, and a dedicated advisor on how to list it. I think we've seen a few startups go after that space. There's a company in Utah, Homey, that's basically owns is the number 2 realtor in the market now, and they do this. So this is possible, and this is happening. And I think that's a massive opportunity for a lot of startups.
And do you want to jump in?
Yeah, I was gonna. So I used to have that mindset until we started buying houses ourselves. Then what I discovered is that, so I don't disagree with you. In fact, we're technology investors and enablers. So we're constantly looking for ways to make the market more efficient, right? So the idea of losing 5% of your home value in that transaction, I think it's a little bit unfair to the consumers, both the buy side and the sell side. So I'm a believer in sort of getting rid of that. But I think when you're making such a big purchase decision or selling decision, for average consumers, so let's sort of get rid of the HBS, MBA, and the GSB grads, right? So we're talking about the everyday, right? So it's kind of nice to have an advisor. And the moment you have an advisor, so even for someone like me who's pretty savvy negotiator, I know valuation, I know auction dynamics, I look at the macro trends. If I have to deal with an advisor, I need someone to then be in their club to get me the best deal. In other words, the moment the seller hires a broker, if I don't have a broker, that means someone else is going to beat me as a buyer. So I don't know how long that takes for that sort of market dynamics to change for sellers like us or buyers like us. One day say, all right, let's all sort of agree, let's not use intermediary and just do it all sort of online.
But that's the way buying a car used to be. And I don't think it is today, right? I mean, you think about, TrueCar, you think about like just Consumer Reports, the amount of information that's out there. Isn't it possible we might get away from that?
I think it's possible. I'm questioning about the timeline. We bet on like cancer curing drugs, CRISPR technology. So we could sort of have that investment horizon. But I think going from the car to house, this is literally the single largest purchase most people face. And on top of that, how many of you has debt in this house, in this room? Everybody, right? So I first of all, I think it's actually, even if you don't need debt, you should take out debt because debt is cheap. If one thing I learned from my business school Finance 101 is that you separate operating decisions from financing decisions, right? So you finance. So basically we'll all lever it up like around 10, 15 times. So it's a big decision, right? So if that's one of your biggest decisions, I don't know how long it takes for average consumers. Like for us, yeah, I could sort of go without an advisor, but I just don't know how long it will take for the Main Street to sort of wake up and say we don't need an advisor.
So just to respond to that real quick. So I think the question here is, so I actually think it's the opposite. I think it's people like us who might be buying more bespoke houses where they need more sort of custom advice. I think in a lot of parts of America, you have large developments where every single house is the same. They turn over very quickly. The valuation is completely automated.
Very noble.
And I think the key is to dissociate value from price. And I think consumers are going to realize pretty quickly when their neighbor is selling a house and paying a $500 flat fee to someone who ends up providing really good advice. We all know that the real estate agent who's helping you sell your house is not on an hour per hour basis. If you take that 3% and divide it through, that's a pretty high hourly rate. So if you can drop that down, you can still provide quality advice. In fact, you could probably do better because you'll have different people who are specialists in each step of the process. It will take time, but we've seen it take off. I mean, I think there is becoming a precedent there, and I think you're actually going to see it in the cookie cutter spots where it's easier to automate.
So does that look like 5 more Redfins proving themselves and developing critical mass with consumers, or what sparks the flame?
I think it's a great question. As a question as a VC, you always ask, like, is this going to be sort of a regional, local phenomenon where everyone's going to have access to similar technology and, great businesses will be built, but nothing is going to be built at massive scale and massive venture style returns. And I think that's going to be, I don't have a great answer to that. I think a lot of this technology, a lot of this enabling technology is available to everyone. It's a pretty level playing field. Which to me says that the sort of, then the folks who are going to win on distribution. That's a very expensive place to play. My sense is that's going to be largely a regional affair, but I could very well be wrong. We'll probably have a few more players like Redfin. Be curious to get other thoughts on that too.
Sorry, I feel like I'm hogging here. Weirdly, what I think will make a big difference here is just pervasiveness and adoption of VR headsets. I think the moment at which most of us have that technology in our homes, every home becomes shoppable. All of a sudden, we're Pinterest style, like browsing other people's homes, and this experience just fundamentally changes. Like, if I don't have to schedule a time to go visit a house, it's going to totally change the liquidity profile of kind of buying interest. So I don't know when that is, but is that 2 years from now, 3 years from now? I do think that's coming, and I think like a lot of us, that's really all we need. I mean, even today with virtual walkthroughs, you can see a lot, but if you can actually sort of walk it through in HD, AR, I mean, like that sounds like pretty compelling. I don't know.
I'd love to go look at fixeruppers. And I'll tell you, half those fixer-uppers look amazing in the photos, and then you show up and realize that there's no back wall, right?
But wouldn't you guess you're a specialty?
Yeah, but there's a lot of that. There's a lot of that in the market, right? I mean, there's the people who want the nice shiny new, and there's, whoever said the tract housing, like that's exactly that model, right? It's the exact same thing over and over again. But there's still a lot of like legacy product on the market that has to be converted at some point.
I was going to say, I walked a couple properties in Arizona that I walked in and I thought to myself, these homes should sell themselves, right? And they were completely outfitted, smart home technology. I didn't have to go visit, very similar to what you said. I could have done the virtual visit. I didn't gain anything by stepping in foot and going through the backyard and everything. It was exactly how it was online. And I could have monitored the cameras, the thermostat, the front door lock, as you mentioned. Everything was done in a way that the home should have sold itself.
And to Alex's point, I mean, we kind of we make a bigger thing of this because of the friction in the ecosystem. So I know we're evolving from mortgages into home buying, but like, I mean, if you think about it, like we rent, often people rent without ever visiting an apartment because we're like, oh, it's only a year. I mean, we're committing for a year and hopefully it's not terrible, but if it's terrible, like it's only a year. Like with a home, you're like, oh, it's a 30-year mortgage or a 15-year. I mean, like, so you're like, that's forever. It shouldn't be. I mean,
yeah, I was just gonna say, based on kind of what you said versus what I said, it's evolving. Actually, what is the product of buying a home? And I think you touched on in your intro, right? When you look at how is home buying going to change, the pricing, packaging, all of that, I think that's really what drives this, right? Volvo just announced with their XC40 that they're like, basically you're gonna buy it online, you're gonna pay whatever dollar amount a month, and it's gonna be the car, the insurance, and all your maintenance. And when you're done with it, you can just give it back and they're done. And that's that pricing and packaging model, I think, is what has to change to push a lot of this.
I just want to say, I think none of us probably qualify here. I think if we bring our wives and this girlfriends here, they will tell you what really goes on. I'm in charge of the financing and my wife is in charge of the selection. So I just kind of figured out how to get that paid. So AR/VR, I'm a big fan. And I think until we could convince our wives that's the way to go, it doesn't matter what the husband says.
They want to touch it.
But you can also, I mean, open door. You schedule your own open houses when you go look at one of their properties. So it almost sounds like, just hearing the conversation, that when we think about mortgages evolving, it's a lot of convergence. You think about this 10 years out, whatever the time frame is, we'll get it wrong, but there's a process. The home buying hangs off it, the mortgaging, financing hangs off of it. And let's change gears now and kind of talk about some other aspects of mortgaging. So I know we wanted to talk about servicing. Were there things in that space that you guys wanted to touch on as kind of challenges or opportunities, outside the purchase of the home or the refinance of the mortgage?
Well, I think the compliance side of default mortgage servicing, I think you mentioned that right now that's very manual. It's mostly done in Excel and paper, and it's a huge headache where basically there's an opportunity for a win-win for both the home. People think of it as a zero-sum game, like you're either in the home or you're not. The reality is there's ways to make a deal that leaves both parties better off and lowers the operational cost, because it's very, very expensive to kick someone out of a house. That's just an egregiously expensive process. So I think that's obviously a very interesting piece. There are other things like mortgage servicing rights, as many of us know, are very much like basically just a bet on interest rates in many ways. And so the people who buy them and the people who are holding on to them are always concerned. It's really just a bet on, like, it's a macroeconomic bet, and maybe you can hedge it out. But there's a lot you can do. Like, you've got this customer who's paying you every single month, and no one's really doing much on that piece of it, which seems sort of silly because that's the relationship you end up having. And there's probably lots of ways to move the needle on, making those mortgage servicing rights valuable, all sorts of different things. Selling, cross-selling, upselling other financial products. Like, can you build a better consumer experience on that side to maximize that opportunity?
do you think mortgage servicing rights should be a separate asset?
But you mean they are?
No, I know. But, I'm just asking you a more fundamental question. Like, this is my problem with the current sort of ecosystem.
Right. I mean, it does split the incentives, right?
Totally.
Which is why you care about who's the servicer, if you're the holder of the mortgage. But yeah, it's a pretty funky situation, right? If you can hold the mortgage, the problem is then like, what startup can hold a mortgage and also innovate on servicing? You have to really forge these deep partnerships with the banks who have the balance sheet to actually hold these things. So I don't know how that plays out in a way that there can be innovation in this space.
Well, I mean, you could have contractual relationships for servicing, even if you don't, like, with a bank who holds the mortgage. You know what I mean? That could exist. I mean, it feels like in general, to your point, like servicing in general, like we're here to talk about mortgage, but if you look across categories, I saw an interesting startup that was trying to do this in student and ran into some issues, but it's like that's a relationship that, if done correctly, you should be able to monetize in many other ways. You certainly know a lot about a consumer based upon how they kind of pay or don't pay their bills. And candidly, there's a lot of sort of data there around like somebody like if somebody pays at a certain time and then they don't pay at that time, like the ability to sort of message them dynamically across multiple channels. I mean, there's a lot of innovation that could occur in that. So I'm with you. I think there's a lot of innovation to happen in servicing. Whether or not regulation makes that possible, that's the question. But I hope we're able to see some of that innovation come to market.
Yeah, I agree with you from a product person perspective. That's kind of how we look at it, right? Servicing is something, it's a transaction that's happening and people aren't taking advantage of it. People aren't approaching it the way they should. You buy a house, you go through some mortgage company and you're like, okay, I'm with this person for 30 years.
Yeah.
And then the next, a month later, they're like, congratulations, you're now with so-and-so. And you're like,
they sell it right away.
Yeah. Like, what happened? Did I miss something?
I was going to say, so we are active investors in both the underwriting process as well as just the whole mortgage process itself. What we've found is that, especially in the emerging market, people are starting to use untraditional underwriting data. And it's actually quite efficient, but these are not mortgages, right? So you're seeing smaller, loans. And I could totally see that this sort of goes into more mainstream, larger deals. And I think the only reason why there are smaller deals is because there's not enough capital. And once you sort of prove out an underwriting model, you could totally take some of the even social signals. And then to a certain extent, I feel like mortgage, it's asset backed, so it should be easier, right? The person, you know where they live because they bought a house, right? So I think that's inevitable. So I'm actually a lot more optimistic this is going to be a lot sooner. And then
outside the U.S.
Well, I'm hoping. I think it's worldwide. I think this is a financial product. You could prove out a successful underwriting model that doesn't require, tons and tons of tax return, FICO score. I mean, FICO score and just whole. That can of worms. Like this thing shouldn't even exist, right? But anyways, so and then you talk about after the underwriting process, closing the mortgage, the amount of paperwork. I mean, I've never had to deal with a notary except when I buy a house, when I sign out a loan, right? And that was when I realized that industry still exists, right? So we invested in a company called Factum. So they use a blockchain to try to just do that one little piece, right? And that's a big enough a piece to make an independent company. So I think there's a lot of, if you kind of look at it from a high level, the whole mortgage process, there's quite a bit of low-hanging fruit just for process improvement. Instead of having me, pay a notary signing 50 pages of document, they take it back, store somewhere in the vault. That doesn't add any value except to check the regulatory box. And I think that's a very easy place where we can all agree. You can agree with the banks, you can agree with consumer. That should be digitized.
So does the startup ecosystem, I want to, as we kind of draw toward the end, I want to talk about some of the things you're looking at from like an investing perspective and kind of in the startup space, some of the managerial and business development challenges. Does that mean that really the focus is it's more of an enterprise play? The startups are here to not replace banks and replace credit unions and non-bank originators, but they're really there like blend to help them kind of upgrade their processes and really help them become more competitive because, as you mentioned earlier, they've already solved some of the fundamental challenges like distribution. I'm just curious kind of how you think about the interplay between like incumbents and new entrants and really, where the startup success focuses. Is it displacement or is it really helping banks transform?
Yeah, I mean, I can speak for us. We're very much about helping banks transform, right? But how do we actually up-level them? Because when you look at someone like Quicken Loans and Rocket Mortgage, there's very few players out there that can invest that much money and how they actually get there, right? I mean, the rumors are hundreds of millions of dollars that were invested to actually produce this. So when you look at a lot of the IMBs that are out there, when their sole product is mortgages, they're not like a depository that they can rely on checking accounts and all these other different avenues. their sole focus is improving this, and they can't invest in technology at that scale. So that's where someone like us comes in, and we help them level the playing field.
I think in the U.S. for mortgages, enablers. It's everybody who's tried to be a direct challenger has faced a lot of challenges. Outside the U.S., mortgage is still the toughest loan product to compete as a challenger, but for alternative lending in general, I think there's a lot more optimistic of a profile.
Yeah, I think I'd agree with that. I guess I would add, actually, you haven't talked much about Unison, but I think that's a whole other interesting space of what other sort of innovative financial products can we incorporate into the purchase of a home to even make it more affordable, to change the fundamental structure of ownership. Someone once asked me, like, why can't I rent any home that's for sale? And it's sort of an interesting question. Like, the reason that we don't do that is because high transaction costs, which we've talked about, and because there's no really good way of hedging home value risk. But you lower transaction costs to zero, and you create some liquidity in the home price derivatives. And why couldn't I just have a property management company own a house, someone else takes ownership, hedges out the home price risk, whatever the case might be. It's sort of silly that we have to either lock ourselves into this like home asset or like we just do rent. And largely because those two things are not just financial decisions. For most people outside of cities, the inventory is fundamentally different. You have a fundamentally worse experience when you're when you're renting versus when you're owning. There's a lot of opportunity to innovate on the financial product side here that I think would be very interesting.
And let's touch on that. So Unison, down payment assistance. You see companies like Point, really offering alternatives to HELOCs. Where do you see some of the financial product innovation kind of happening?
Well, the demand, and to answer the original question, which I was going to jump in on, is that we sort of sit in between a lot of the FinTech space and a lot of these new players. And what we hear from them is they actually listen to the consumer. They're responding to the demand of the consumer, right? Where some of the legacy banks, lenders out there, they're deaf. They're not reacting quickly enough. And where the Points and the Unisons and the Open Doors and everybody we have these gigantic lists are able to service a specific need and get it to the consumer today. And from Unison's perspective, we're able to service a massive need. Consumers can't afford the down payment on a home in San Francisco.
That's true.
Right? We're able to double your down payment overnight, safely, responsibly, and reducing risk in the system. And so companies like Unison, Point, others that are out there right now, this is going to grow. Equity is here as we're going to have this commingling of debt and equity in residential real estate. It's here to stay.
Yeah, I think it's a good point. I think it's that first piece, the enterprise piece, just improve the process is what I call the low-hanging fruit. But contrary to other industries, this low-hanging fruit is actually quite large. This is a vast low-hanging fruit. And if you introduce some interesting technology, it can actually be disruptive. So this part of the market that we just talked about, I think is actually pretty interesting. It's more interesting than most other enterprise I've seen. If you look at the consumer side, I think that's where you could build a large brand as big as sort of Bank of America, JP Morgan of the world. So I think that's really exciting, but it is much harder. But I do think fundamentally, as I alluded to earlier, the underwriting model, there's got to be an improvement so we could do a better, like startups could do a better job. At that point, it's just really access to capital. How could you access a pool of capital so there's economy of scale? That I think will come very quickly because at the end of the day, investors want return. So if you could demonstrate return, the moment it works, I think capital flows fast. So like large companies could be made in this space, and it'll be much larger, and it could happen very quickly.
And let me just, in these panels, you always want to ask kind of the regulator question. So you think about somebody like Uber. I mean, they kind of went out there and educated and got regulators to change, and very successful. When you think about this space, really a two-part question. First, How big of a challenge to innovation and evolution is, the state and federal regulatory regime? And what do you think needs to be done to educate them about these possibilities and help them get on board and be supported? And I'll just throw it out to whoever wants to start.
I think we should let the audience answer.
I can just comment on that real quick. I think there's a lot of good laws that are in place for very good reasons. I mean, we all went through the subprime crisis. I think typically, legislation always tags behind technology, right? And our ability to accomplish what they're trying to accomplish in a less burdensome way. You could have the Uber example. The way we approach it is helping with compliance is more of a strategic advantage than trying to skirt the regulators. And then that's how we kind of level the playing field and create a product around it. But then the next phase is how do you actually change that regulation?
When are we open up to the audience for questions?
So 2 questions regarding enablers and challengers. What are your opinions on Better or SoFi, which have really, like Better is a new company got funded recently, and they're really challenging the banks, if you will. You can go online, get pre-qualified within minutes, and so are there any? That's my first question. The second is mortgage origination is a distributed process. Like there are so many parties involved. So do you see technologies like blockchain, which are essentially a distributed ledger, coming into 4 or 5 years or 10 years? Where we are right now.
So there's 2 questions there. I think to be fair to everybody else, let's try to just answer one of them. I mean, the first one I think is those models seem to be working. I mean, if you think about what Quicken's done, I mean, those two they seem like analogs, right? I mean, it's just improving that origination user experience to the best you're able to. So the question I think we all have to ask ourselves about that model is, let's say you're super successful and you have a bunch of operating metrics. How are you valued at the point at which you want to sell the business? And that's always the important question I ask when I think about companies that are kind of trying to compete directly with traditional institutions. And I think what you find is that, kind of in the mortgage space, especially the mortgage originators, you're not going to get a very attractive multiple of revenues when you sell your business. So, I just would suggest people don't be confused between, a technology company and an originator. The blockchain question, I'm going to defer on. I don't know if anybody else has to.
We're a big proponent of blockchain, so we're always looking for any sort of big market to apply to. I think this is a perfect industry. If you look 20 years later, it should be decentralized, and you shouldn't have a big central sort of player in the middle, not the bank, and it shouldn't be the government. I think it should just be completely decentralized. But it's easier for us investors to make the 20-year bet. It's the 5 years, it's a little bit harder to predict.
But given, capital markets or secondary will exist, Chinese and Freddies will exist, so you still think that we can get to a model where it can be peer-to-peer and...
I would say TBD. Who else would like to jump in with a question?
Yeah, I have 2 questions actually. Does any one of you know of a company doing disruption in terms of reducing the cost in terms of interest rates? Kind of like the way Uber did by lowering the cost of using taxis? One question. Any of you know the company in America with the lowest mortgage rate? I'm in the process of buying a house, so I'm just...
Well, I mean, I'll speak to the interest rate question, but let me ask one of you guys if you want to jump in first.
I'll jump in first, if you don't mind, because I'm constantly sort of looking at refi. It's Bank of America. It's the volume player. I try
it's the lowest cost capital, right? It's the guy who has the lowest cost capital.
Yeah, exactly.
Most deposits.
Yeah.
There you go.
Yeah.
Bank of America.
Yeah.
I went to SoFi. I put in all my impressive credentials of all the taxes I paid. like 1% higher than I get from Bank of America.
Yeah, I mean, just to add to that, I don't think there's any mortgage company that expressly competes on a lower interest rate as their value proposition. What I do think you see, and like Ethos Lending is a great example of this, you do see mortgage companies that have a very efficient process. By having a lower cost to originate, they're able to pass on a lower rate. And then you'll see that show up virtuously in their conversion. For example, if they're advertising in the Zillow Mortgage Marketplace or through LendingTree. And so what ends up happening is by being efficient, by tackling many of the issues you all have talked about, they're able to compete on price and effectively scale profitably.
That's a good answer.
So the one you go maybe is it?
Ethos Lending. Who would like to go next?
I was about to just add to that. I've seen this overseas, where you can actually have an FX-linked mortgage, so you're willing to take the currency arbitrage, and that is actually how certain banks have managed to drive down mortgage lending significantly lower. You do run the risk of a currency arb, so you can borrow in yen, right? At, like 0.02%.
Yeah.
Or 0.03, but you do run that arb. And I've actually seen that play out through Mitsubishi.
Yeah, so just having lived in Washington, D.C. for 15 years, good luck getting something like that.
Yeah, that's not going to pass.
Who would like to go next?
Yeah, so where does this go? I mean, like with mortgage, we talk about like incremental improvements, so making it like a little bit faster, going down to 15 days, but like, thinking of like the long term, what is like the ideal state? What's the use case that you think it's going to be at 20 years from now? Getting a mortgage in the U.S. is going to be what?
So I'm just always willing to talk. I don't know. There's not an infinite supply of residential real estate. At a certain point, you ought to know what it kind of all is. So like, theoretically, it'll be a lot easier. It'll be lower friction in terms of figuring out what something's worth, and kind of the transaction costs around selling it, leasing it, kind of for a day, for a week, for a year. Like, I don't know. It feels like we ought to get to a spectrum of ownership, whether that's kind of leasing or owning.
Yeah, I think so too. I think in that sense, there'll be a lot more products on the market for mortgages, because I think we kind of live in this legacy world, and because the friction of actually getting the mortgage has so much upfront costs and so much trouble, that we now live in this situation where we have to go for this 30-year or this 15-year or these longer term things, but being able to reduce all that cost out of the system, all of a sudden there's becomes a volume game, and you can make little bits of money here and there.
We're about 4 minutes. Why don't we take one more question from the audience, and then we'll do wrap up.
Do you mind expounding a little bit on the FICO-free underwriting model and how that works and where the data comes from?
Sure. So we recently invested in a Indonesian company, and then also previously invested in a Chinese company. So this is not mortgage, right? This is underwriting for small loans, and it's targeting people who don't have access to credit. And you basically do a few things. You could look at their social graph and use that to derive basically how stable this person is.
Or what does that mean?
How many friends they have, like their phone log. Basically, you take their phone log to figure out, you have their social media handle to figure out if this is a person who has been around. And you take information, and you do stuff like character test. You ask them a question like, where are you right now? But you already know where they are. So you kind of just test their honesty. So through a bunch of these signals, you basically decide if I want to lend to this person or not.
Awesome. Well, why don't we we'll wrap up, and I guess kind of the wrap up question would be, started with what do you want people to take away? Is there anything you want to add to that, or anything new that comes to mind after hearing this discussion? Let's go down the road.
I think actually there's a lot of good points made, a lot of good conversation, and I think that the point is the change is here. It's happening. It's happening pretty fast, and there's a lot of momentum behind it, as I touched on before. But I think there's still lots of other opportunities. We touched on servicing. Servicing is definitely a huge opportunity. So, if you're entrepreneurs or things that people who are looking into this space, there's plenty of low-hanging fruit out there still.
Yeah, I actually feel like this discussion has expanded my thinking a lot on this. That's been fun, but I would encourage you, if you're entrepreneurs, especially to, this is a big, huge industry, lots of problems. So definitely keep at it and, find the problem you can solve and that unlocks value for the consumer. Ideally by working with an institution. That would be my advice.
That's the point.
Yeah, I think the only thing that I think we could also touch on is just take rate per mortgage. Seems like a massive market, huge dollars in terms of real estate, but just keep in mind there's about 10 million residential mortgages every year originated, and so if you're think about feature product business, if you're sort of an appendage on this entire process, your ability to capture significant market size might be limited. So think about how you be more central. Ellie Mae has done a very good job of capturing about $160 per mortgage. I think some of the upstarts are, sort of trying to plug in, but they're gonna have a hard time getting into the core and really capturing that value. And put that in perspective, the average mortgage is $8,000 of revenue. So think about, if you're an entrepreneur, how do you capture the most of that? Where can you be to capture as much of that as possible to build a really big business?
I think from a financial lending perspective, as we've sort of discussed, it's going to be very slow. It's going to be a slow process until Fannie and Freddie get overhauled. But in that interim, I'm going to sort of think through what the consumer is going to do. We're going to see co-borrowing and co-owning on the rise. We're already seeing that happen. We're going to see a plethora of apps that are going to streamline that process for the consumer as they respond to the demand of living in a Seattle, living into a Chicago, living in a San Francisco, where you simply can't afford to own the home, so you will co-own the home. And I think long-term, the agencies are going to have to respond to the consumer demand and be more dynamic long-term, because we're saying 5 years, but 10 years, this is going to get turned on its head.
For instance, you're using the 10-year investment horizon. If I think 10 years, definitely think about using blockchain's ability to deal with data, an audit process. It's just the perfect ledger, right? So it's accurate, it's cheap. And if you think 20 years, think about the decentralized aspect of blockchain on the origination discovery side. That gets a little bit more wild, but you can kind of imagine if you have enough time, then you can have all kinds of peer-to-peer transactions that happens on the fringe.
So I want to thank you all panelists and also Charles for great moderation. Thank you so much.